So we're going to do a presentation in two parts. The first part will be an overview of the outlook, the economic outlook for sub-Saharan Africa. The second part will be a deeper look at particularly the commodity price shock. So here's the general background. You have a general background of a global economy where growth remains moderate, modest, sluggish, choose your adjective, and not a very fast-growing global economy. And against that background, you see sub-Saharan Africa is slowing down. Compared to the growth rates in the past, the last 15, 20 years on average, you had 5-6% growth, some countries even faster than that. The IMF now estimates that in 2015, growth was about 3.5% in sub-Saharan Africa, and our outlook for 2016 is at most 3%. So definitely a much weaker outlook. So what I'm going to do today is a presentation in three parts. I'm going to talk a little bit about why it is that growth has slowed down. I'm going to talk a little bit about what countries have done to react to that. And I'm then going to turn to what is the title of our current report, which is Time for a Policy Reset. And as Ms. Sayeh said, I'm going to talk a little bit about why we think that those countries most affected by the downturn have not yet taken the necessary policy steps to respond. So this should be quite a familiar picture to you. Natural resource producers, oil exporters in particular, are experiencing a significant slowdown. You can see in this chart, these are the 8 countries in Africa that are large oil exporters. You see the black line is the average growth rate achieved over the period 2010 to 2014. The red bar is what they are likely to reach in 2016. And you can see that with the exception of Cameroon, everybody is growing more slowly than they did over the last 4 or 5 years. And this shows you that the same is true for other commodity exporters, with very few exceptions, Tanzania being one of the exceptions. But you can see across the board, metal exporters also significantly affected by this slowdown. But I should underline that it's a tale of two Africas. You have the commodity exporters that are facing serious issues, and I'll come back to that later. But you also have a significant group of countries that continue to grow quite robustly. And here you see that for those other countries, growth is often more or less where it was over the last 4 years, in some countries even stronger than where it used to be. So keep that in mind as we go through this. Africa is a heterogeneous continent. You have a sharp slowdown in some countries, big countries, Nigeria, Angola, South Africa for other reasons, but you also have a large number of countries that continue to grow quite robustly, from Senegal and Côte d'Ivoire in West Africa to Kenya, Tanzania, Uganda, Rwanda in the east. Now here's a chart that tries to put the oil shock into context, and the context here is the bar all the way on the left. This is the largest decline over an 18-month period that we've seen in recent history. So it's been a very severe shock for the oil exporters in Africa. And just as an illustration, this of course is affecting also sub-Saharan Africa's trade relationship with China because of lower oil prices, because also of the rebalancing of the economic growth in China. Sub-Saharan Africa's trade balance with China has turned into a deficit for the first time in many years. Now that's one shock that sub-Saharan Africa is facing, lower commodity prices. But there is a second shock that also weighs heavily on prospects, and that is that external financing has become more expensive. You can see in this chart, the red line are the frontier markets in sub-Saharan Africa, the Ghanas and Zambias and Nigerias of the continent, for example. And you have the black line, those are the emerging markets outside of Africa. And you can see that in 2014-15, spreads were rising for both of them, but since then it has been much more severe in sub-Saharan Africa. And that affects, of course, the access that frontier economies have to global financial markets, access that have increased quite rapidly in recent years, and now, at minimum, the cost and probably the access itself is going to be much more difficult. Now, on top of all of that, in our view, the risks are still on the downside. I've summarized here some of the global risks. Indeed, there could be a further decline in oil and commodity prices, despite the slight rebound that we've been seeing in recent months. Certainly could be more volatility in global financial markets for many reasons. Brexit next week would be a case in point. And a further slowdown in Europe is certainly not excluded either. And then you have domestic risks that are very much centered on the African continent, protracted policy adjustment, I think by which we mean that the policy adjustment is actually not happening, at least not yet. A more prolonged drought. We have a severe drought affecting a number of countries, particularly in Eastern and Southern Africa. And of course you have security challenges across the Sahel belt, but also over in Kenya. So you have a number of risks that could affect prospects quite significantly. Now, how have countries responded? This tries to illustrate one response, namely fiscal policy. It's a bit of a complicated chart, but the story is quite easy to tell. The black dots are the change in revenue. So you have a significant drop in revenue, notably for oil exporters. And the red triangles are the change in expenditures. And you can see that in most countries, expenditures have not yet adjusted fully to the fall in revenue. Of course, as a result, deficits have widened. And the next chart, which looks at debt, illustrates that. Again, all the way on the left, you have the oil exporters. The red bars are the additional debt that countries have incurred. So you have widening fiscal deficits, you have rising debt. Fortunately for many oil exporters, you have a reasonably strong starting position, starting with reasonably low levels of debt, some reserves, sometimes significant reserves, so that there was a little bit of time. But as I'm going to illustrate in a moment, we think that time is running out. This chart shows that not only are deficits rising, debt is rising, but the financing costs of these deficits is also rising. The size of the bubble here corresponds to the increase in domestic interest rates to finance the deficit. So you can see that in many countries that has gone up significantly. Zambia and Angola are cases in point. And then on the two axes, you can see that the fiscal balance has worsened. Those are the countries below the horizontal axis in many countries. So financing costs are rising, fiscal balance is worsening, and of course that poses significant challenges for many countries. How have countries dealt with this? There's been, in some cases, increased resource to central bank financing. As you can see here, the red dots above the green bars in many countries, particularly in the CEMAC, the fixed exchange rate regime, in Central Africa, which has many oil exporters. There's been increased recourse to central bank financing, and we know from experience that can pose inflationary risks down the line. Countries that had or have the opportunity to do so have let their exchange rates adjust. Angola, Mozambique, Zambia, cases in point, which is probably the appropriate response. In terms of trade deterioration, permanent shock, an adjustment in the exchange rate makes a lot of sense. But you can also see that adjustment has been quite uneven across countries, even though they've been facing the same shock. The adjustment in Nigeria, for example, has been far less than in Angola. And of course, some countries, again the CEMAC countries come to mind, do not have an exchange rate instrument. That puts additional burden on fiscal policy. Countries, again, that have monetary policy independence, that have a flexible exchange rate, have used monetary policy to try to offset some of the inflationary risks. So you can see that in many countries, and in this chart, it also means a slowdown in private sector borrowing. So we've seen in many countries, we can see the slowdown in credit to the private sector, which translates, of course, into a slowdown in growth in many countries. And similarly, it also puts pressure on the banks and financial system more broadly. As the economy slows down, as interest rates go up, the non-performing loans that many banks hold have started to creep up, and so banking sector risks are rising in a number of countries in sub-Saharan Africa. So, against this rather bleak picture, I guess the question you could ask is Africa still rising? What does this mean? Is this a rough patch, a weak period that is going to be overcome, or is it in fact a change, a more fundamental change in the growth model in sub-Saharan Africa? Is what we've seen over the last 15 to 20 years, is that now something of the past? I think that is the key question that many are asking themselves. The answer that we present here is that the underlying drivers remain strong. The fundamentals remain strong. We discussed it a little bit last year for those of you who were here. The analysis that we've done in recent years shows that a lot of this growth, the 15 to 20 years worth of growth, was not driven by natural resources, certainly not by natural resources alone, but that strong economic policies, stronger institutions played an important part. And those are not necessarily gone. Those are still in place or can indeed be reinforced. So our view is that Africa medium-term prospects remain strong, but in the short term, for sure, a policy reset is required. So these are the kind of short-term policy responses that we have been urging countries to take. On fiscal policy, the fiscal adjustment is urgently needed for oil exporters. There is just no way around it. A country like Angola, lower oil prices have meant government revenue has fallen by 20% of GDP. There is no alternative than to adjust to such a shock. On the oil importer side, many countries continue to enjoy strong growth rates, and that is certainly a positive. But it is also an opportunity to build buffers. It's an opportunity to ensure against future shocks. I mentioned global financial markets being one constraint, one obstacle that all countries in Africa are starting to face, and downside risks are also obvious. On the monetary and exchange rate policy, I think I discussed it a little bit. Those who have the space, the opportunity, the ability to do so, should use the exchange rate as a buffer to adjust to a terms of trade shock. Monetary policy should accompany that to make sure that the exchange rate depreciation does not translate into runaway inflation. And central banks should be careful not to overextend themselves and limit the amount of government financing that central banks engage in. Now, for Africa to continue or to return to growth rates of the past, I'd like to mention three areas for policy action in the medium term. And a lot of this draws on some of the analytical work that we've done over the last couple of years. Revenue mobilization, very important. It's also, of course, a big theme that came out of the Addis conference. And that's for obvious reasons. To the extent that you are less able to raise financing either from markets or from your development partners, building stronger domestic revenue bases is important. The need to reinforce resilience. I talked about buffers. That's certainly important for countries that are susceptible to shocks. And increasing competitiveness. That is particularly important for countries that have a less diversified export structure. And then third policy priority is to make growth more inclusive, and I'll come back on that in a moment. This is a chart from our report 6 months ago, where we did some analytical work to look at revenue potential and using some econometric estimates. I think on average we estimated that there was still significant potential for more domestic revenue in a number of countries. We have some listed here. I think on average around 3.5% of GDP that could still be raised on domestic revenue. And I think that all the more important given the important expenditure needs that many countries are facing, both infrastructure and social spending. This complicated chart comes from an analysis of sub-Saharan Africa's integration in global value chains that we also did last year. What it shows, sub-Saharan Africa are the dots in red, and you can see that a lot of sub-Saharan Africa is below the curve, i.e. less integrated in global value chains than would be needed to have sustained growth. But you can also see that it varies, and I think we have in our report some examples of countries that have been able to integrate more into global value chains. Ethiopia comes to mind, Kenya, Tanzania, and a few others. So there is some progress that has been made, but overall there's still a lot of need to do better on the competitiveness front. And competitiveness is not only, of course, about global value chains. It's a lot of sort of micro aspects to competitiveness, starting with infrastructure development, for example, that would be very important, that I'm not going to get into here, that we all know is absolutely crucial to competitiveness. And this is the third area that I mentioned, reducing inequality. This comes from a report we did also about 6 months ago. What we tried to do is we looked at both income inequalities and gender inequalities, and estimated that if sub-Saharan Africa was able to reduce inequalities to levels seen in Asia, you could gain at least 1 percentage point in growth per year. This is research that fits pretty well with research we've done also beyond sub-Saharan Africa over the last couple of years at the IMF. Sub-Saharan Africa has very large inequalities, particularly gender inequalities remain among the most pronounced worldwide. So there's really quite a lot of scope for gaining growth that can be shared better than it is today. That's all I'm going to tell you. I know it's a snapshot, but if there are two things I'd like you to remember, which is that, yes, in our view, it is a rough patch, but it is a rough patch that requires countries to take action, particularly those that have been heavily hit, particularly the oil exporters. And it is also a rough patch that, in our view, is going to be followed, or can be followed, by a return to the growth rates of the past. But again, that is not automatic. It requires putting in place medium-term policies, 3 of which I illustrated here, and I'm happy to talk more about it in a moment. So with that, Professor Euler, I'll pass it back to you, and Celine can maybe take over in this microphone.
Okay, thank you very much, Roger.